Analyzing 1 billion records of data in under 10 seconds? Man, that's fast.
Hi, I'm Melanie Rodier, Senior Editor at Wall Street and Technology, and I'm here today with Larry Tabb, CEO and founder of Tabb Group, and we're going to be talking about data management strategies for risk and analytics. Hi, Larry. How are calls from investors for more transparency and new regulations affecting the ways that firms manage their data?
Well, a lot of the transparency rules, a lot of the Dodd-Frank, MiFID, EMIR, you name it, they're all really pivoting around transparency. And so the issue with transparency is people need to understand what products are they trading, what are these products valued, how are they being valued almost, I wouldn't say on real time in terms of risk management, but much more real time than folks are used to dealing with valuations of these products. And so the issue really, it's a data problem more than anything. It's just aggregating terms and conditions, aggregating positions, analyzing what they're worth, trying to create a value on them, trying to do analytics on them, and then trying to figure out what's the sensitivity if interest rates or market conditions change, and then just trying to really understand how all this fits together with your financial conditions. So all of this is all of these rules are intrinsically intertwined with data and data management and data clarity.
In what new ways are firms looking to use their data for risk and analytics?
Well, I wouldn't necessarily say there are new ways. Well, there's certainly always new ways of analyzing risk, and I think that one of the things that we've seen from the credit crisis is that people's ways of analyzing risks are not necessarily right. Because if they were analyzing risk properly, I don't think they would wound up in the same issue. And in fact, we're starting to see firms look at agent-based modeling and all sorts of different ways of really rethinking how to stress test a portfolio and do it more accurately. That said, a lot of this stuff is still, pretty theoretical. Folks are still probably more focused on VAR in terms of analyzing risk and scenario and stress test than anything. But that said, folks are looking at new ways of looking at data to actually create alpha, which is kind of a little bit more interesting. And I think what we have seen is that folks really focused on speed a lot. And I think especially in the equities market, we've kind of maxed out speed as a factor, especially with volatility and volumes. And folks are looking at higher grade analytics to really try to find patterns in the data that aren't necessarily as transparent, as well as folks are starting to look at unstructured data and analyzing unstructured data. And you need all sorts of different tools and services to be able to, take that analysis to the next level.
Larry, given flat IT budgets, how are firms managing changes to their data management processes?
We're starting to see new different ways of trying to really do macro data management, and really, especially when you also look at LEI and restructuring how folks are handling, counterparty numbering and analysis and large trader ID from the SEC. There's a lot of investment going into data management. The problem is that, as you said, budgets aren't really cooperating. So I think to a certain extent they're trying to do, rob Peter to pay Paul. So they're shutting down other initiatives and focusing them on infrastructure and data infrastructure. They're also, I think a number of years ago we saw many firms kind of invest in these multi-million dollar reference data infrastructures. We don't see firms doing that as much anymore. And so I think what you see more is, more messaging oriented management where the reference and infrastructure lays in the systems that are the systems of record, and they then pass that information to subsequent systems instead of trying to create a complete set of terms and conditions for everything within the organization, because those things get massive and hard to cost justify. But you can then you can invest in making your fixed income system as robust as possible, and then if the equity system needs some fixed income system, data, pass that across and let the fixed income system be the where the data of record lies. And so you see a lot of the messaging infrastructure work being done so that they don't have to create these massive databases that are almost obsolete by the time they're created.
Larry, are there any new data management technologies or processes that you think firms are going to be using in the near future?
I think what, depending upon what happens with FINREG, I think it'll be interesting to see, what happens overall with data. So the question then becomes is, we've already seen Basel kind of water down a little bit the liquidity, their liquidity ratios, so their liquidity coverage ratios, so their LCRs, so they can, don't necessarily need to use treasuries all the time anymore. And so the question becomes is how much more is this going to get watered down? What's going to happen with Volcker Rule? What's going to happen with Basel III? What's going to happen with capital requirements? What's going to happen here? If everything continues to stay very onerous and very focused, I think what you're going to see is the industry's got to contract. And so what's going to wind up happening are the banks are going to wind up reducing the number of products they cover, reducing their balance sheets, and simplifying their organizations from that standpoint. So it'll be more of a, let's focus on what our core business is. Then what you're going to see are these newer firms develop, and we're starting to see them that are very sector focused or very focused, within a specific asset class or geography, and they're only going to create the infrastructure they need for those products. So we're going to start seeing, to a certain extent, a whole bunch of new siloed businesses come up, and it's going to be kind of the next generation banks, but they're not actually going to be banks. So these guys are going to be very focused. The bigger banks are going to pare back. They're going to be layered on with all these new regulations around larger trader ID, the financial reporting, new risk management infrastructure. So and then you're going to see the hedge funds really look at and the prop shops look at alpha and what do I need to generate alpha, and to do that they're going to be increasingly focused on analyzing data 12 ways from Sunday. And so you're going to see things like Hadoop come in, and you're going to see different ways of being able to leverage very large data sets to find not even needles in haystacks, but needles in states. Just really looking at massive quantities of data and analytics to really drive that. And then from a reference standpoint, I think, I wouldn't say the days of these massive databases of terms and conditions and reference data are dead, but I'm not sure we're going to see a whole lot more of them. I think you're going to start seeing folks try to connect these silos and pass information, and more messaging infrastructure be created rather than these big massive databases.
Thank you very much, Larry, for joining us today.
Great to be here, Melanie.